Joining me today on NYSE Floor Talk is Abe Finkelstein. He's the co-managing partner at Vintage Investment Partners. Abe, fantastic to have you here. Thanks for joining me.
Wonderful to be here. Thank you for having me.
So Abe, Vintage invests in growth stage startups as well as VC funds and acquires secondary positions in both across the US, Europe, and Israel. Tell me about the firm's strategy and how these pieces fit together.
So we started the firm back in 2003 as a secondary fund. We raised a $64 million secondary fund with the idea that we would buy out limited partners from their investments in venture capital funds and also do direct secondaries in the companies. Today we manage about $4 billion across 3 strategies, including the secondary funds. We also have a fund of funds where we invest in what we believe are the best VC fund managers. And we also added a growth strategy where we look back into the fund of funds and the secondary funds to cherry pick what we believe are the best companies. So we really believe by having these 3 strategies, there's a lot of synergies and we get a 360 holistic view on what's going on in the venture market, in the funds, in the companies.
Now, how does the growth stage investment environment look for you right now versus the high watermark of 2020 and 2021?
Yeah, so it definitely looks a lot better than 2020, 21. That was really a crazy period of time where valuations really didn't make a lot of sense. We were actually trying to get out of more things than we were getting into at that point. I wouldn't say that we're at a bottom as of yet. I think we're getting close. We are seeing that valuations are getting much more reasonable, but still the great companies that are coming to raise money when they're coming out to the market, they're still raising at pretty frothy valuations. So I think we'll need a few more quarters to see the valuations start to settle down. But we're well past what was going on in 2021 and 2020.
Now, considering the current IPO landscape, how does Vintage view the pipeline for public market exits versus M&As? And what implications does this have for the portfolio strategy?
Sure. So it's really incredible to see that the pipeline for IPO potential companies is as large as it's ever been. Companies are now much more efficient. They're getting to cash flow positive or close, and they're not selling just in the hundreds and 200s of millions of dollars. They're selling 300, 400, 500, even some $1 billion. So we really believe that once the public market opens, there's going to be a flood of amazing companies that are going to come to the market. So bankers are going to be extremely busy. I don't know when that's going to be, if it's the end of next year, 2026, but it's definitely as attractive as it's ever been. M&A is interesting because M&A, you see a lot of cash in the hands of the large buyers. I'm talking about hundreds of billions of dollars, but M&A has been much slower. And I think it's a combination of a few things. One is that private companies are still being priced higher than public market companies. I also think that what's going on the regulatory side has made a lot of the buyers more wary of going into M&A transactions. So, well, I think that's also going to come back. It's going to take time, and the focus really at the end of the day needs to be on these IPO-able companies, the ones that can be big standalone companies over time, and I think that's just going to continue and continue. So while I do think M&A will come back, I'm not sure it's going to be as fast and as large as we expected.
And what trends are you observing with IPOs, and how is Vintage capitalizing on these opportunities?
Yeah, so again, we're really focused. For example, when we invest in a fund, we want to invest in a manager that knows how to find the next great IPO-able companies. And same with our direct investments in the companies. We're talking more and more to our founders and entrepreneurs that it's really about you have to go all the way, or maybe you need to now go and think about you should sell your company. So while the IPO market really isn't open right now for VC-backed tech companies, we know it's going to happen. And when it happens again, I think the floodgates are going to open. So it's really important to start positioning for yourself for those IPOs today, because you probably have 18 to 24 months to do that, which is a great period of time.
All right, and finally, tell me, how is Vintage positioning itself for the future in terms of innovation and emerging investment trends? And what new opportunities are you excited about?
Yeah, it's a great question. So we're actually different than a lot of groups like us that have these 3 different strategies, is that we divide our investment team by sector. So we have sector specialists on our investment team. It could be enterprise infrastructure software, it could be games, it could be property technology. We also have people focused on health and climate, for example. So 2 areas that we've been spending a lot more time in have been health and climate. We see, for example, we haven't touched on AI yet, which, how could that be in a conversation, but we see, for example, the application of AI to healthcare and even to climate really being able to dramatically change those industries. So we believe, for example, those are 2 examples of industries that we believe can be massive going forward. And what's really interesting is we're seeing high quality entrepreneurs move into those sectors, start companies in those sectors. And that's really a good sign that we think those can be big areas going forward.
All right, well, Abe, it's been wonderful to talk with you.
Great,
Thanks for joining me on Floor Talk.
Thank you so much, it was great to be here.